Have you ever wondered how significant property sales impact the multifamily real estate market? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Starlight U.S. Multifamily Number 2 Core Plus Fund has recently completed the sale of a substantial property in Denver, Colorado, comprising 400 multifamily residential suites. The property, located in the Parker submarket, was built in 2018 and sold for cash proceeds of $133 million. This sale marks a significant transaction within the multifamily sector, illustrating the ongoing demand and investment opportunities in this asset class. In conjunction with the sale, Starlight announced a special cash distribution on its outstanding units, payable on July 15, 2025, to holders of record on July 8, 2025. The distribution amounts vary by unit class, with Canadian and U.S. dollar values reflecting current foreign exchange rates. This strategic move highlights the fund's commitment to delivering value to its investors while managing its financial obligations effectively. The proceeds from the sale are earmarked for repaying the property's mortgage in full, totaling $96.2 million, along with the fund's unsecured debt amounting to $11.8 million, including accrued interest. The remaining net proceeds will be distributed to unit holders as part of the special distribution. This financial maneuver underscores the importance of strategic debt management in maintaining the fund's financial health and investor confidence. Following the sale, the fund retains ownership of two other properties, a 275-suite property in Orlando, Florida, and a 320-suite property in Raleigh, North Carolina. Both properties are classified as Class A institutional quality and contribute to the fund's diversified portfolio. However, the fund is currently negotiating loan extensions for these assets, highlighting the complexities of managing a multifamily real estate portfolio. The sale of the Denver property and the subsequent special distribution reflect broader trends in the multifamily real estate market, where strategic sales and distributions are leveraged to optimize portfolio performance and investor returns. As we continue to observe these developments, it's evident that multifamily properties remain a cornerstone in the commercial real estate landscape, offering resilience and growth potential. Blackstone has made a significant move in the commercial real estate sector by acquiring nearly $2 billion worth of commercial real estate loans from Atlantic Union Bank. This acquisition follows Atlantic Union's recent completion of its acquisition of Sandy Spring Bank, based in Maryland. The transaction was part of Atlantic Union's strategic plan to streamline its portfolio post-acquisition. The portfolio acquired by Blackstone consists of mid-Atlantic commercial real estate loans. This acquisition is a testament to Blackstone's ongoing strategy of expanding its commercial real estate loan portfolio. The company continues to position itself as a major player in the financial landscape by acquiring assets that promise strong returns and stability. While this transaction highlights the dynamic nature of the commercial real estate market in the United States, it also offers a perspective on cross-border relevance, especially when we look at similar trends in Canada. For instance, in the Kitchener-Waterloo region, we see financial institutions also focusing on strategic acquisitions and asset management to bolster their portfolios, similar to Blackstone's approach. These strategic acquisitions not only enhance a company's financial health, but also provide a buffer against market fluctuations. In the multifamily real estate sector, both in Canada and the United States, such moves are critical as they ensure a stable cash flow and potential for growth. This cross-border similarity underscores the interconnected nature of the real estate markets in North America. A Chicago-based firm, North American Real Estate, has made a significant acquisition by purchasing the retail portion of the iconic Tribune Tower, one of Chicago's most renowned buildings. This acquisition marks the first time that the ground level of this neo-Gothic structure, located at 435 North Michigan Avenue, has been sold as a retail-only property since its completion in 1925. The Tribune Tower, originally home to the Chicago Tribune newspaper, has a rich history and international recognition. The building's redevelopment into residential condominiums by CIM Group and Golub & Company did not include the retail portion, which North American Real Estate has now acquired. This strategic purchase aligns with the firm's focus on discounted retail properties in key Chicago neighborhoods. The retail property, which spans 47,000 square feet, is currently only 36% leased. Tenants include the Museum of Ice Cream, a Blue Bottle coffee shop, and a luxury watch retailer, A. Lange and Zona. The property's prime location offers 218 feet of frontage on Michigan Avenue, with additional exposure to the bustling Pioneer Court. North American Real Estate's principal, Savas Air, expressed enthusiasm about the purchase, noting the resurgence of foot traffic on Michigan Avenue and the desirability of the Pioneer Court location. Air envisions attracting a mix of smaller tenants, such as food and beverage providers, as well as larger retailers to fill the vacancies, capitalizing on the area's renewed vibrancy. This acquisition reflects a broader trend in the retail real estate market, where strategic purchases are being made to leverage high-profile locations undergoing revitalization. The move by North American Real Estate underscores the potential for growth and profitability in Chicago's Magnificent Mile, despite historical challenges in the area. The Miami Brickell City Centre has become a focal point in the urban real estate market, showcasing a significant recovery and strategic repositioning of retail and mixed-use assets. Recent high-profile sales, including the $1.2 million transaction of unit number 3611 and the $211.5 million land sale to the Mello Group, highlight the enduring demand for urban living spaces with premium amenities. This trend is indicative of a broader shift towards mixed-use developments that blend residential, retail, dining, and entertainment components, attracting both residents and tourists. Completed in 2023, the Miami Brickell City Centre combines luxury residential towers with a 500,000 square foot retail and entertainment complex. The sales activity in 2025, such as the $1.2 million sale of a 36-floor unit at $947 per square foot, underscores investor confidence in Miami's financial district as a prime mixed-use hub. This momentum marks a stark contrast to the post-pandemic slump that once affected urban retail, with occupancy rates in U.S. cities showing a steady climb, particularly in Miami. Swire Properties' pivot from its original plan for a 68-story office tower to luxury residential development with the residences at Mandarin Oriental Miami further illustrates this trend. The $800 million in pre-sales for the project, now exceeding $1 billion, highlights robust demand for high-end residential units. This shift aligns with a national trend where residential demand is outpacing office space appreciation, driven by global capital and Miami's status as a gateway for international buyers. For investors, the Miami Brickell City Centre sales offer actionable insights. Mixed-use developments with retail, residential, and hospitality components provide diversification and stability. Prime urban cores like Miami's Brickell, Manhattan's Flatiron, or San Francisco's Financial District retain premium value, as demonstrated by the $211.5 million Mello Group deal. Furthermore, converting underused office sites into residential or mixed-use projects can unlock significant value, especially in cities where zoning laws allow such flexibility. However, caution is warranted amid this optimism. Overbuilding in luxury markets could strain valuations, and office vacancies, currently at 17% in Miami, may persist. Investors must consider operational risks, such as high maintenance budgets for high-end amenities and substantial association fees that could deter some buyers. The sales at Miami Brickell City Centre are more than transactions. They are a roadmap for real estate recovery, illustrating the potential of urban cores that balance functional utility with aspirational appeal. Terreno Realty Corporation, a prominent player in the industrial real estate sector, has announced the successful execution of a lease agreement for 81,000 square feet in Avenel, New Jersey. This lease has been secured with a third-party logistics provider and is set to commence on June 30, 2025, with a term extending through to November 2030. Terreno Realty is known for its strategic focus on acquiring, owning, and operating industrial properties in key coastal markets across the United States, including New York City and northern New Jersey, Los Angeles, Miami, the San Francisco Bay Area, Seattle, and Washington, D.C. This latest lease agreement further solidifies their presence in the New Jersey industrial market, a critical logistics hub in the northeastern United States. The company's strategic expansion and leasing activities reflect broader trends in the industrial real estate sector, where demand for logistics space continues to rise. This demand is particularly driven by the growth of e-commerce and the need for efficient distribution networks. The lease in Avenel, New Jersey, underscores Terreno Realty's commitment to positioning itself in high-demand markets that offer robust growth potential. As we compare this with Canadian markets such as the Kitchener-Waterloo region, we notice similar trends where industrial spaces are being increasingly sought after to meet logistical needs. The cross-border relevance is evident, as both Canadian and United States markets are experiencing a surge in demand for industrial and logistics real estate, driven by the same underlying economic factors. This strategic lease by Terreno Realty not only highlights the company's proactive approach in securing long-term tenants, but also reflects the overall health and resilience of the industrial real estate market. As we continue to monitor these developments, it's clear that industrial properties are a vital component of the commercial real estate landscape, offering stability and growth potential. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.